So welcome back to the channel. In today's video, I'm going to be walking you through 5 manageable and easy steps you can use in order to improve your trading results this year in 2024. So before we get into these 5 steps, I would love to know what your goals are for this year, trading related, and also how you plan on achieving those. So make sure to drop those in the comment box below. Make sure to also like and subscribe for more content like this. And let's get straight into the first step. Alright everybody, so as I mentioned, welcome to this video, and these are going to be 5 ways to level up your trading results in 2024. So let's get straight into the first step, which is to start journaling. So journaling is one of the key things in order to help improve your trading results because, or simply put, if you aren't sort of journaling your results where you are doing well, where you are going wrong, how do you know if your trading results are improving or not? So we want to be making sure that at the end of every single day, I do this normally around 6 p.m. UK time, so after the New York session volume has died down and I'm not going to be taking any trades. And what I'll simply do is go back through that day's price action and see if there were any trades that I missed according to my trading plan. Obviously, you can always catch a trade if you go back in hindsight and trade it. But I mean missed trades that fit your trading plan. So for example, if your trading plan says to enter, for example, on a breakout, then if there were any breakouts that day that you missed, was that a valid trade according to your plan? Make sure to journal that down. And also, more crucially than that, if you actually end up taking any trades that day, make sure to also record them. And this includes the technical aspect of the trade. So whether the trade met your entry criteria and your strategy. And also make sure to also jot down the emotional side of the trade. So this includes how you were feeling before you executed the trade, while you were in the trade, if you ended up taking it, and also how you went about managing the trade. So for example, if your management plan says, as does mine, never make trades break even unless there's high impact news, and then you went against that rule, jot down why you think that was, that you went against that rule and broke your plan. Maybe it was because you had been on a losing streak and then you were scared of losing another trade, so you wanted to protect your capital, so you made the trade break even against your plan out of emotion and out of fear. These are all things that are very useful looking back on your results that you need to jot down, and this is going to help to elevate your trading simply because you're going to know exactly what your faults are, so what is keeping you from improving your results, and what is preventing you from following your trading plan exactly as it is written. You know, most people can follow their trading plans when they're backtesting, but you really want to focus in and dial in on what prevents you from following that to the absolute T when you are live trading as well. And for many people, that will be the emotions, which is why it's so important to jot down the emotional aspect of your trades when you're in them and also after they play out as well. So if I go over to Google Docs now, I'm going to be showing you a simple format that you can use to journal your trades if you don't want to pay for an expensive journaling software such as Edgewonk or TradeZella. Those are the 2 main ones that I would go with. Edgewonk is the one that I'm currently using. So this is the Edgewonk website. It would be my go-to journal. It has pretty much everything you need, a place to journal all of your trades, and it also records all of the statistics as well of your journal trades. You can also journal missed trades, write notes on them, include screenshots, things like that. But if you don't want to pay for one of these journals, which are quite expensive, I think Edgewonk you have to pay upfront £200 for the year or something like that, then you can simply use this Google Doc that I'm about to take you through. So the first thing that we need to jot down when we take a trade is obviously the profit slash loss. So you'd obviously have maybe a table, so day or date. So record the date of the trade, number of trades taken, net profit slash loss. And for this, I would record this in percentage terms. So for example, you could have plus 3% rather than writing down the monetary value, because that's going to obviously vary with your account size. So it's much more informative and useful to jot down the percentage rather than the actual monetary value. So that's what we're going to do. Net profit slash loss in percentage terms, for example, 3%. And then we want to have screenshots of before and after the trade. And ideally, you also want to do this on multiple different time frames so that when you look back, you have that multi-time frame perspective on why you decided to take the trade. And then you can also compare that to trades that you're looking to take in the future or at the current moment as well. So screenshots before and after, net profit slash loss. And the other main thing that you probably want to write down is just any comments on the trade. So these are going to include the technicals, which means why did you take the trade, and also crucially, did it fit your trading plan, and also the emotions. How were you feeling before the trade, during the trade, and how did you go about managing the trade? And if you feel like you handled the trade badly, maybe you got out early due to loss aversion and fear of a loss, then make sure to jot that down and make sure to sort of think of ways and do a little bit of self-analysis in order to see why you made those mistakes, and hence how you can prevent yourself from making them in future trades. So yeah, emotions, technical aspect of the trade, and these are really the only things that you need. Obviously, if you're collecting data on other aspects of your strategy, such as what sessions are best for your strategy, things like that, you can also make sure to include them here. But these are the key points that I would make sure to journal at the end of each trading day, and also make sure to jot down the missed trades that were valid according to your strategy here as well, as that will be a big help to you in the future, and also will help you to gain trust in your strategy as well, as you've obviously seen it playing out multiple times in the live market. So on to stage 2 now, which is something called a weekly ASR or advanced self-review, which I did a complete video on a couple of weeks ago, which you guys can go and check out after you watch this video if you would like. But if you want the brief summary, ASR or advanced self-review is the process of introspection and self-analysis in terms of your trading performance. So this means at the end of every week, I do mine on Friday evening after New York session when the volume has died down, so I'm no longer looking for any trades, and therefore I am in a clear-headed state of mind where I am solely focused on doing this and nothing else. So at the end of the week, start by backtesting the whole week on bar replay for each of the pairs that you trade. For myself personally, this is only 3 pairs, so it doesn't take me very long, maybe half an hour or so. But basically, go back through the week's price action on bar replay and sort of reflect on the perspective of the market that you had at the time, i.e. what analysis did you have at the time, what trades were you looking for, and how did this compare to how the market actually played out. Write down any trades that you took during that week, plus any missed trades that you journaled, and go back through and review these trades, the technicals and the emotions are the same as in when we were journaling the trades initially, as I mentioned in step 1. And going back to Google Docs, the simple format that I use to do this, if we scroll down a bit, so the simple format that I would use, actually I can show you guys an example of this. So this would be the format that I use. So going to the very beginning, I would jot down the number of trades that I took. For example, this week, it was one trade for a total of -1% because we had one losing trade on USD JPY. And as you guys can see, I've taken a screenshot of the trade on multiple different time frames. I would then review the technicals, and this is why I took the trade, which was a valid trade according to my plan. And then psychology, I basically note down any emotions that I experienced at the time and any slip ups I had with the trade management or in the actual execution side of the trade. In this case, there wasn't any, so that's why this paragraph is very small. I would then record any missed trades that I had during that week. So for example, this one was a GBP USD 1-3 position that fit my entry criteria, but I missed it because I was waiting for a confirmation at the time, which was sort of against my plan because I didn't need to wait for a confirmation. This was valid to just set a buy limit. And then again, for every missed trade that I missed, I will jot down the technicals and also the psychology, so the emotions as well. And in particular on missed trades, you want to jot down why you think you missed them. For example, did you get fear of entering the trade and then that caused you to miss it, or you were out at the time so you weren't on the charts, so things of that nature. And then I would just do this for all of the missed trades that I missed during that week. Most of these also come from when I backtest that week as well. As I mentioned, you want to go back through and backtest the week, which is why there are so many. And then at the end, I will just write a brief summary of my performance during that week. What went well, so for example, the analysis, and I didn't force any positions in an overall slow week, I believe this was. And then even better if, just some points to improve on going forward. For example, don't overthink trades. If it's valid, just take it. So that is simply the process of advanced self-review. And obviously you guys don't have to do it in this exact format. The process itself is the important part. And as long as you are going back and reviewing how you did that week, that's all that really matters, because obviously you're not going to improve if you don't review your past performance and then from that deduce how you can improve your overall results going forward. So step number 3, and I would anticipate that a lot of you have already done this, but this is going to be a more systematic approach and an overall more business-like and formal approach to doing it. So backtesting, at least 3 years worth of data or more than 100 past trades to see that, first of all, you have an edge over the market. And second of all, to see that edge playing out multiple different times. Because, for example, I could give you my exact training plan and my exact strategy, but without going through and spending hours backtesting it, you're not going to have trained your eyes to see the setup over and over again, and therefore you're not going to be as sort of swift at recognizing when the setup is forming and also which ones are valid, which ones are invalid. So things like that, you're not going to know which trades are likely to play out and which ones aren't, based on seeing the trade play out hundreds of different times. But anyway, once you have those 100 past trades backtested, I would recommend doing this using a simulation software such as FX Replay, instead of just doing this on TradingView Bar Replay, because then you can avoid cheating. And the reason you can avoid cheating is because on FX Replay, you don't have the option to scroll back in time once you've already played price. So that means that you can't go back after you've seen the price and say, oh, I would have entered here and this would have hit take profit for 5%. Things like that, which I know a lot of people will probably do because of their confirmation bias, because they want to see their strategy have an edge. and they often do this on TradingView bar replay, where you can do this without any issues. So it sort of forces you to reflect on the trades and correct yourself. So sort of that negative feedback process, where if one trade hits stop loss, what did you do wrong during this setup? Were all of your confluences there? And if not, why did you enter this trade against the plan? On TradingView bar replay, obviously you can just say, oh, I wouldn't have entered this trade, so I'm just going to remove it from the data. And obviously that is going to massively skew your results. And when you come to live trading, it will be a completely different story. So it's better to do it on one of these simulation softwares like FX Replay to get the sort of most realistic data set and to see your edge play out in a real trading environment. And then next of all, which I know a lot of people probably don't do, they just backtest for the sake of backtesting. You want to make sure you record the summary statistics. So the main ones that I would write down and the ones that are going to be most useful in order to improve your results going forward are your win rate and your average risk to reward. These are the two key ones, because from win rate and average risk to reward, you can obviously calculate your expected profit over a certain number of trades and whether you actually have an edge. So for example, if your win rate is 50% and your average risk to reward is a 1 to 2, obviously over time that is going to be profitable in terms of the probabilities and maths behind that situation. But if you have a, say, 50% win rate, but your average RR is 0.3, so a negative risk to reward, then obviously you're not going to be profitable over time. And then you may want to go back and refine the strategy and add confluences or change it ever so slightly in order to improve it before going into a live trading environment, because in that scenario you obviously wouldn't be profitable mathematically, so there is 0 point in taking that strategy to the live market. On top of actually collecting, before we go forward, another summary statistic that is absolutely key if you want to scale your trading in the future is to record your max drawdown. So for me, max drawdown is calculated by simply looking at the maximum number of losses that you had in a row. So for myself, this was 7 trades this summer. So my max drawdown would be 7% because I lost 7 trades in a row. And the reason this statistic is very important is because if you guys go and take prop firm challenges and your max drawdown is, let's say 15%, so you lost 15 trades in a row, then you probably want to rethink risking 1% on these prop firm accounts where the max drawdown is usually 10%, because obviously if you lose those 15 trades, risking 1%, you're going to blow the account. Whereas if you were to risk only 0.5%, then you would have to lose 20 trades in a row in order to blow the account. And if your max drawdown is 15%, then that is very unlikely. So yeah, the importance of this simply is just to see if you have a mathematical edge. And obviously if you don't, go back through and change some stuff or refine your strategy before taking it into the live market. On top of the statistical side of backtesting, you will also gain confidence in your strategy because you have, again, like I mentioned previously, you will have seen it play out hundreds and hundreds of times, so you will know exactly what a setup looks like when it is forming in the live market. Also, because you've seen the strategy play out so many times, you will start to know exactly when and where to enter. For example, you can anticipate that a setup will likely form when price gets to this level, or a setup will likely form when London session opens at 8 AM UK time, or things like that. And this simply means you're not sat there staring at charts all day, which is detrimental to your trading performance, because it means you are more likely to be forcing low quality setups that are likely to lose just because you're bored and you want to feel involved with the market. But yeah, that's all I wanted to say on backtesting. Simply put, and to summarize all of this, make sure your back testing is as realistic as possible so that you can repeat the strategy in the live market, and that you have some very concise and clear-cut data on the strategy which you can then implement or mess around with in order to improve those statistics as well. So going on to the next step, and I know a lot of people will not be doing this, is to simply focus on one trade per week. So I know a lot of people in trading, they feel like because they're a trader, they have to be sat in front of the charts, placing positions all day long. So even if you're placing 5-10 trades per week, that is very unprofessional, and is very unlikely that all of those positions are high quality A+ setups that are likely to play out according to your strategy. So one thing that I would recommend learning over time is to be very selective with the setups that you actually take, and only take A+ setups which have all of your confluences. You know that statistically it is the setup is occurring at a optimal time, for example London session open for myself, or maybe in Asia session or New York session open, whatever it may be. Make sure they are A+ setups with all of your confluences. And something I like to remind myself from time to time, when perhaps my patience is running thin, or I'm feeling eager to be in a trade just because I'm bored, I remind myself that one trade per week can be 12% in a month if all 3 trades hit a 1 to 3, which is my minimum risk to reward. So if all of the 4 trades that I take in 1 month hit take profit, that's 12%. That is a very good annual return for any investor. You know, the benchmark for investing is 8%. That is what hedge funds aim to beat if they are dealing with large capital. So simply put, don't set unrealistic expectations of taking 10 trades every single week and thinking that's going to mean that all of them are going to hit take profit and you're going to make a large amount of money very quickly, because that's simply not the case, and often is the case in trading that less is actually more. So take fewer trades, and yeah, see how that massively improves your trading results. It also teaches you patience, which is an essential skill in trading. So patience in trading is absolutely paramount for good trading performance, because if you don't have any patience, then you're going to be sat there forcing low quality setups which are likely to lose, and that's going to cause you to go into this sort of negative cycle of losing trades, not taking winning trades because you doubt them because of the previous losing trades, and all of this sort of emotional turmoil that comes with losing trades which stemmed from your lack of patience. So patience is definitely one of the most essential things in your trading, and the patience to particularly wait for those A+ setups which have all of your confluences is a very necessary skill in order to improve your trading results going forward. One more thing I want to mention on this topic is think in terms of having large prop firm capital. So if you only have a £1,000 account, say, obviously making 12% in a month is only £120, so it's not a lot. But if you more so focus on the skill aspect, so focus on the skill of trading and your ability to consistently make those types of returns, then you can very easily go over to a prop firm, secure 6 figures in capital, where that 12% becomes 12, 24, 36, 48,000 in a month very, very quickly, just because you have the skill of consistently making those returns. So even if you can make, say, 2% on a 400k funded account per month, that's a 1 to 2 every single month, then that's more than 6 figures in a year, obviously before the profit split and taxes and things like that. But the point is, focus on the skill of trading rather than the monetary value, and the money will follow, simply because your skill can be applied in order to secure the prop firm capital or private investor capital if you have a consistent track record as well. So number 5, and this is something that most people neglect when they're trading because there is no sort of direct relationship between them, is to simply prioritize health. So exercise and workout every single day, ideally at a specific time every day, so you have a routine centered around the charts and your trading. Make sure you're eating good quality foods, minimal processing, avoid artificial sugars or anything that's going to cloud up your brain and cause brain fog, which obviously is going to have a detrimental impact on your ability to think rationally and clearly, which is in turn going to have a negative impact on your ability to make good financial and trading decisions. And then that's going to impact how much money you ultimately make and your yearly returns in your trading. So a lot of people I know neglect this, but it is still a very, very important aspect of trading. And pretty much all of the successful traders that I know, they prioritize health and are into self-development, working out, and eating healthy foods. And I recommend if you're in any business, you do this anyway. Due to the fact that, like I said, your health impacts your mind impacts your ability to make clear and rational decisions, and your decisions impact the outcome of your business and of your trading. So finishing up here on number 5, make sure to prioritize your health. And I hope you guys all found this video very useful. If you did, make sure to comment below your goals for this year in terms of trading, how you plan on achieving them, and also if you found any of these 5 steps helpful and you plan on implementing them going forward. So thank you guys for watching, and I will see you guys in the next video.